Welcome back, everybody. I'm now back from my break, so sorry I haven't been uploading, but I thought the most appropriate video to give to you would just be a quick basics of Forex. I get asked a lot by people who aren't maybe in the trading sphere about Forex, so hopefully this will explain to you, and maybe if you are a beginner trader and still don't really have any clue, it will shore up a few ideas. So what is Forex? Forex is known as a few things. So you have FX, foreign exchange. It's a global market and it has a daily trading volume of $5 trillion. So that's more than every single stock exchange combined. And that's what makes it one of the best areas to trade in, because there's so much liquidity and that provides so many more opportunities than, say, trading on the London Stock Exchange or the American exchanges. So a simple example would be if you are living in the US and then you want to buy some cheese from France or some wine, either you are buying this or the company that you're buying it from has to pay for that in French currency, which is the euro. That means that the US importer would then have to exchange the equivalent value of the US dollar into a euro to pay for it. And that is simply how the Forex market works. So a unique aspect of the Forex market is that it's completely electronic. So it's OTC, which is over the counter, meaning that any average Joe can set up a trading account and learn to trade and trade it themselves. It's open 24 hours a day, 5 days a week. Is it a scam? I hear this probably from the majority of people who aren't in the markets, and they warn people about not taking the risk of going into the market, or don't do that, oh, it's a scam. But it isn't a scam, and the only thing that it should be worried about are perhaps depositing money with an unregulated broker, or giving thousands of pounds to educators who are connoisseurs of marketing and BS, basically Astro FX. But some advice from me to you, if you are looking to get into Forex and be in the markets. If you're based in the United Kingdom like I am, so do not choose a broker that's not regulated by the FCA, because as soon as you do that, you're asking for trouble. There's a reason why they aren't regulated. And the same goes if you're in the US. I know FX is a bit different over there and it's options and tip-tap, but if they're not regulated by FINRA or the CFTC, just leave them alone. There's no point touching them, because you will find that you'll probably get burnt. And one of the main benefits of being regulated is that you have the assurance that they won't just run off with your money, and that your money is kept in a separated client account. So with regards to the trading educators that I touched on before, think of it as when you're buying a car. Don't just part with your thousands and thousands worth of cash on a course that promises riches and you're going to get really, really wealthy within a year, because the chances of that are not going to happen. 95% of new traders fail within the first year. You are not going to be within that 5%. Do your research and ask for a proof of their history within FX and trading. If they claim to be trading for 8 years, Astro, have a look at their history. If they haven't got any history, then just leave them. Because if they've been trading for 8 years, they wouldn't be selling courses. So first of all, what is a Forex quote? Foreign exchange currencies are traded and quoted in currency pairs. So euro versus the dollar, the US dollar versus the Japanese yen, or the pound versus the US dollar. For example, it's for the pound sterling versus the US dollar. Your quote currency would be the pound sterling, and then your base currency would be the US dollar. And then you've got your exchange rate of 1.41. So the difference between the bid and ask price, something people don't really take into account. The ask price is the price that sellers are willing to sell at. So equally, the price you pay when you enter a buy trade. And the bid price is the price buyers are willing to buy at, the price you pay when you enter a sell trade. So it's as simple as that. It's not a key part of your trading, but it's good to know what an ask and bid is. Spread and swaps. So spreads is something in the retail world that people care a bit too much about. having low spreads isn't a major part. Obviously, if you're scalping, that's better. But if you're a swing trader or a position trader, spreads rarely actually matter. So the difference between the bid and ask price that we spoke about before is called the spread. And the easiest way of thinking about it is that spread is essentially the cost of entering your trade. Also, remember to factor this into your risk management, because the spread is still a spread between the price. So I've included on the screen the fourth column along with the exclamation mark. That's the spread. You'll find that on MetaTrader if you just click on to options and choose spread, and that will bring up your spread. And you can easily calculate it between the bid and ask. A swap, however, is the cost of holding a trade overnight. Swaps exist because different countries have different interest rates. In some cases, your swap will be credited to your trade. So it'll be on a smaller, say 0.01 lot, it'll be a couple of pence or cents if you're American of profit, or it might be negative because it may be debited from your account. But that is all part of your trade. Your major, minor, and exotic currency pairings. So first of all, you've got your major currency pairings, and these are the euro against the United States dollar, which is also known as FIBA. Your major, minor, and exotic currency pairings. So first of all, you've got your major currency pairings, and these are the euro against the United States dollar, which is also known as FIBA. And then secondly, you've got the pound sterling against the United States dollar, which is known as cable, thanks to the transatlantic cables. Then you have the United States dollar against the Japanese yen, which is called the ninja. Then you have the United States dollar versus the Canadian dollar, which is also referred to as the loonie. So you have the United States dollar versus the Swiss franc, which is known as the Swissy. The Australian dollar versus the United States dollar, which is known as the Aussie dollar. And lastly, the New Zealand dollar versus the United States dollar, which is known as the Kiwi. Then for minors, you have things such as the euro against the pound, euro against the yen, euro against the Canadian dollar. There's loads more. Exotics could be the US dollar against the Turkish lira, or the US dollar versus the South African rand, which is the ZAR. Some interesting ones are the SEK. So SEK stands for the Swedish krona, and likewise NOK means Norwegian krona. HKD is the Hong Kong dollar, and the SGD is the Singapore dollar. So there's many more exotics and minors, but highlighting the key differences between all of these pairings are that the spread on majors is usually the lowest and most consistent, and that's a key part of trading. So you don't want to be entering into a trade where the spread is at 1 minute 50 and then overnight it goes to 450. That's very reckless, because that just in the end will come back and bite you in the ass. Volume is always higher on your major pairings, so there's more liquidity there, so there's less likely to be mainstream volatility such as big spikes up and down. Lastly, volatility, and that is typically larger on minors and exotics as there's less liquidity, so as I just mentioned. So to a beginner, my advice would be hone in on your majors and pick maybe 2 majors and 1 commodity such as gold to start off with, because you don't want to be the jack of all trades and master of none. Learn those currencies and learn about those economies before you start trading 10-15 pairs, because you'll be letting yourself down, mainly because you will blow your account. So the best time to trade the forex markets, so this, bear in mind, this is the GMT timing. So you've got the time for Sydney, Tokyo, London and New York, so the main 4 big sessions. So you can see that they do overlap each other, and the main trading session and volume takes place between London Open and the sort of first 2 hours of New York. So if I was a beginner, and this is personally what I do, I rarely trade in the Asian session. So from 8 to 5 a.m. I rarely touch, because of those moves. They can be a little bit stronger because of the lack of liquidity, because there's less trades moving in the market, there's less people in the market, because typically you'll find that the big institutions, we would trade between London and New York. So like I said, those overlaps. So between the Tokyo London session, it's pretty thin and there isn't much happening. So yeah, it's a snooze fest. And then by 6 a.m, European traders, they're in the door, getting ready to look forward to the day ahead. If you're thinking of trading in the Tokyo London overlap, I personally wouldn't advise it, and just go play some PUBG or Fortnite, or just go do something else and wait until London New York open. So London New York session overlap, this is where everyone's pants are pulled down, this is where everything happens, and it's the busiest time of the day, because you have two of the largest financial centres, being London and New York, beginning their tug of war of who's going to control the market. And it's during this period you will see some fundamental news coming out from America and Canada, so such as sort of FOMC interest rate decisions, CPIs, bits like that. You'll have to watch out for some late news that may come out of Europe between the times of 3 p.m. till 6 p.m. That can make it quite choppy. So I hope you enjoyed that. Like I said, just a brief and basic touch on Forex. If you know anyone that is looking to trade or wants to just know a little bit more about the market, just send them this. I'll be posting videos as normal from Monday. So enjoy yourself and take care.